Right, well, good morning everyone, and thank you for joining us, and welcome to Quantima's first joint webinar with IBB Law. I'm Ian Barton and I'll be your chair for today. So against the backdrop of an ever-evolving economic landscape, we're pleased to be presenting this joint webinar with IBB Law, where our team of experts will look at directors' duties in detail, how these may alter if the company is in danger of insolvency, and explore the Coronavirus Business Interruption Loan Scheme, or Siebels as it's more well known, with regards to what we're seeing in the market. The Q&A function is open on this webinar, so please do feel free to submit your own questions in real time. We've also had a couple of questions submitted beforehand, and we'll do our very best to answer most of those at the end. Before we kick off, I'd just ask for your patience if we do experience any technical difficulties at all during the next hour or so. And so now let me introduce you to our speakers for today. First up, we have Adam Downey, a partner at IBB Law. Adam is well known, an experienced lawyer, corporate and M&A lawyer in the Thames Valley and West London. He works on all aspects of corporate law, including mergers and acquisitions, MBOs and MBIs, and private equity and venture capital transactions. Adam is respected for his constructive and commercial approach and is included in the Legal 500 Hall of Fame. Adam is presenting alongside Harriet Jones, who's also a partner at IBB Law and sits in the commercial team and acts for both businesses and business owners, from international companies to small and medium-sized enterprises. Harriet specialises in corporate and commercial matters, from data protection to franchising and beyond, and acts for buyers and sellers in acquisitions and disposals. She also advises lenders and borrowers on corporate facilities. Harriet is listed as a future generation partner in the Legal 500. Finally, we have my colleague Adrian Howells from Quantima. Adrian is a corporate finance specialist, his expertise including assisting business owners to realise value and management teams in their buy and build strategy, as well as providing private equity fundraising and debt advice. His sector experience includes working with clients in technology, engineering and the business services sectors. So without further ado, let's start the discussion, and firstly over to Adam.
Well, thanks very much, Ian. Good morning, everyone. I hope you're all continuing to stay fit and well during this lockdown period. As Ian has said, Harriet and I will be looking at some of the legal implications for directors during the current crisis, particularly with regard to their ongoing duties as directors. Harriet is going to give us a quick outline of the director's duties as enshrined in the Companies Act that have evolved over common law over a number of years. I'll then have a look at how those duties may change if the company is in financial difficulty, and also how a board of directors can operate in this existing lockdown environment. And Harriet will then round off with her views of what directors need to bear in mind when putting together a CBILS application in light of their ongoing duties. So Harriet, firstly over to you.
Many thanks, Adam. Various cases during the 20th century established common law fiduciary duties and a duty of care and skill on all company directors. Many of those duties were then brought into law by virtue of the Companies Act 2006, and we'll have a quick look at those statutory duties this morning. However, it's worth noting that these duties excuse me, are not the only obligations on directors, and there is other legislation which imposes strict liability on directors. These range from the duties under the Companies Act 2006 to file documents at Companies House, to legislation which imposes criminal and civil liability on directors for contributing to a breach of environmental laws through consent or negligence. As you'll see on the screen, there are 7 general duties that directors owe to the company as codified by the Companies Act 2006. I'm going to highlight just a few of them for the purposes of thinking about the challenges that directors are facing during COVID-19, rather than go through all of them. Firstly, let's consider the duty to act within powers. Directors must act within any limits placed on them and or the company itself. For companies which have been formed since October 2009, when the provisions of the Companies Act 2006 came into force, most will have what we would consider to be general objects. But for companies formed before that date, And for charity companies who choose to limit their objects, there may be restrictions on what the company can do. These were previously in the Memorandum of Association for a company. So if your company is more than 11 years old and has not updated its articles since October 2009, you may still have restrictions in your Memorandum of Association which may limit the powers of the company. For example, it may limit the ability to borrow money. To ensure that a company complies with this duty to act within powers, the directors should check the company's memorandum and articles just to make sure there aren't any of these restrictions. Now let's consider the duty to promote the success of the company. Directors must act in a way which they consider, in good faith, would most likely promote the success of the company for the benefit of its members as a whole. The legislation further elaborates that directors should consider the following non-exhaustive list for this duty. They should have regard to the likely consequences for any decision in the long term. They should consider the interests of their employees. They should consider the need to foster the company's business relationships with its suppliers, its customers, and any others. It may be relevant to consider the impact of the company's operations on the community and the wider environment. They should also consider the desirability of the company maintaining a reputation for high standards of business conduct. And they must bear in mind the need to act fairly between the members of the company. And Adam will consider this point further a little later in the webinar. Thirdly, in relation to the duty to exercise reasonable care and skill and diligence, a director must exercise the care, skill and diligence that would be exercised by a reasonably diligent person. A nice legal test, I'm sure we all agree. In assessing whether a director has fulfilled this duty, there is both a subjective and objective test. The objective test is that a director must carry out his duties with the general knowledge, skill and experience that may reasonably be expected of a person carrying out the functions carried out by that director in relation to the company. And the subjective test considers the general knowledge, skill and experience that that director actually has. So there is a minimum level of knowledge, skill and experience that is mandatory to satisfy the objective test. But in addition, where a director has specialist knowledge, the higher subjective standard must be met. Whilst directors must consider all of these 7 duties, as you're seeing on the screen, in their day-to-day decision making, it is worth noting, to give you some comfort, that the courts have not held that directors are guarantors of a company's success, and they're not liable for mere errors of judgment. But let's go over to Adam now to consider directors' duties in the context of the company being distressed.
Thanks very much, Harriet, for that useful summary of the day-to-day obligations directors are under in normal business operations. To have a quick look at how those duties may change if a company is distressed or potentially heading towards an insolvency situation. I think in the current rapidly changing environment, directors should be regularly checking to see if, in their view, the company is still solvent. Are they using the cash flow test, and that is to assess whether the company is able to pay its debts as they fall due, or the balance sheet test, which is whether the company has sufficient assets to meet its liabilities. And those liabilities include contingent and prospective liabilities, again, as and when they fall due. I think it's important that directors have to consider when the risk to creditors becomes a real risk that they are not going to be paid. In such a situation, the interests of the company's creditors have to be considered in priority to the normal director's duties that Harriet just outlined. So there becomes a broad duty to maintain the assets of the company for the benefit of the creditors. And this clearly creates a different decision analysis for the directors. Any period of financial distress is clearly going to be a difficult time for directors. And there is clearly a challenging balance between continuing to trade, looking after your employees, looking after your suppliers, your customers, considering your premises, etc., and potentially, hopefully, turning a difficult situation around so that creditors can be paid in full and the business can continue to trade, against continuing to rack up company debt, potentially therefore increasing debtor liabilities weakening the company position and therefore potentially exposing the directors to personal liability. We would say, as I'm sure Quantuma would also, that taking professional advice at an early stage is crucial and can provide significant protection for directors in deciding which particular path to take. Clearly, and I think why the position is different during this recession to previous recessions, is that the government has intervened in a number of ways to attempt to alleviate trading issues for businesses through the furlough scheme, tax deferments, the availability of bank funding, and changes to the insolvency rules, including the suspension of wrongful trading. All these measures, I think, will help limit the risk of personal liability for directors for the decisions they make in a potential insolvency situation. But I think, as Harriet pointed out, directors still must act diligently and reasonably. In light of this, one of the key actions that directors should be doing is to minute all decisions, to document why they have taken a certain route. A director's defence will be much more effective if contemporaneous notes can be shown of the discussions had, the decisions taken, and importantly, notes of the advice that has been received and considered. I think if the directors feel the company is close to insolvency, a regular update, and that can even be daily, or a note evidencing that the company is still solvent and why they believe that to be the case, could be a very valuable defence. I'm not going to go into detail around the potential risk of personal liability for directors and talk about wrongful and fraudulent trading as well as misfeasance. As I said, wrongful trading has been suspended, although there is no specific legislation around this as yet. But in any case, it's misfeasance under Section 212 of the Insolvency Act, which is the more common claim, and this still can render a director personally liable. As I've also said, these changes have not yet been enshrined in statute, and the most important thing, they do not give directors an automatic get-out-of-jail-free card. I think although the changes do not specifically or solely relate to the current pandemic, it would be an extremely brave director who tried to rely on these changes if the business in which they're involved was already in significant difficulty before the 1st of March. And do also note that fraudulent trading remains in force, as does misfeasance, and as do certain reviewable transactions, such as preferences and transactions at an undervalue. So although the suspension of wrongful trading and the other changes to the insolvency rules may help, there are still claims an insolvency practitioner can bring against directors under the relevant insolvency legislation. And directors should be extremely careful if they are proposing to transfer any asset out of the company or pay any creditors in preference if there is any likelihood of insolvency, and should be equally careful of payments made to connected parties, such as through dividends. If we could have the next slide, please. So clearly, the current pandemic does make it an increasingly challenging time for directors, as not only have they got to make some pretty tough decisions, they're not able to meet in person to discuss the relevant issues and discharge their responsibilities. So the need for remote board meetings has become increasingly common. They have been used by many companies in the past, and certainly telephone or video attendance has not been unusual. However, the current pandemic has placed further pressure on directors. So a few issues to consider if you are thinking about holding remote board meetings. Firstly, make sure you communicate with each other in the best and the most secure way. I think over the last few weeks, we've all become used to Teams and Zoom, etc. But often a telephone conference call is the safest way and the least likely way to cause communication issues. However, I think we all do appreciate the advantages of actually seeing someone in a meeting face to face. So if the company and all the directors do have the right and functioning technology, a video call can be an effective forum for a board meeting. Do check, however, that your articles do allow for online meetings. As I think it's clear, regular contact with your fellow board members during the pandemic is increasingly important. However, often a full board meeting might not always be necessary. Consider the use of committees, again, if your articles allow for it, and also consider whether written resolutions can be used to take and record necessary actions. Do bear in mind, however, the importance of recording all key decisions that directors make at this time and ensuring proper and reasonable analysis of the issue has been undertaken. Any challenge to directors' decisions made further down the line will be less likely to succeed if due and proper consideration of the matter was taken by the board and is properly recorded. Any decisions made informally should be followed by a written resolution confirming the course of action. As is always the case with board meetings, up front do ensure there is a clear agenda and that the meeting is run in an orderly manner with someone tasked with taking the relevant minutes. A clear understanding of what decisions need to be made is key, and sending around all the key, most relevant documents to all the parties in plenty of time before the meeting will help smooth and due process. Remote meetings ultimately are no different to a more formal face-to-face meeting. The agenda needs to be adhered to and all decisions noted and minuted. I think with the current, in the current pandemic, a recording can be taken to ensure an accurate record, but we would advise a hard copy of the minutes are circulated and approved by all the attendees. And do also bear in mind the potential security risk of sending around board papers and confidential information. If personal email addresses are being used, then an electronic portal may be a more suitable tool. So to summarise, in what is a challenging time for directors, I think they should be thinking about holding board meetings regularly to ensure that all decisions are taken after due and careful consideration by all the directors. Keep detailed minutes of the meeting and discussions held and circulate them to all directors. Record as much information as possible in relation to any transactions entered into or decisions made, and again, minute why those decisions were made. Review the financial health of the company on a regular basis. Keep forecasts up to date and keep cash flow under control. Keep in touch with your bank. I think that's incredibly important. And if in doubt, engage professionals and obtain advice to ensure and demonstrate that you've conducted your duties diligently and in the best possible manner in these extremely challenging times. Right, Harriet is now going to have a look at how those duties apply in making a CBILS application.
Thanks, Adam. Just to give you a quick overview, I'm sure you're all aware, but the government has announced 3 schemes to support small and medium-sized businesses. The Coronavirus Business Interruption Loan Scheme, or CBILS, the Bounceback loan, which was only launched yesterday, and the Future Fund, which is due to launch later this month. Bounceback loans are for up to £50,000 and have a 100% government guarantee. The government is promising that funds will flow in a matter of days after making the application, as the application form only involves answering 7 questions regarding turnover, tax details, bank accounts, and how the lockdown and COVID-19 has impacted on the business. CBILS are slightly different. They are 80% guaranteed by the government and are for up to £5 million. One important aspect for the directors to consider is that part of the eligibility criteria is the self-certification that the business has been adversely impacted by COVID-19. For many businesses, this is going to be a very easy assessment. If they've had to shut their premises or have had no customers at all since the lockdown, then clearly they've been adversely impacted. However, one new inquiry I had in the last couple of weeks made me realise that some businesses are hearing in the news that it's taking banks quite a bit of time to process the CBIL application. And so they're putting applications in now on the basis that they're fearing a downturn in business in the medium to long term. However, it's important to note that if you haven't been impacted, you are not eligible for a CBIL. The scheme has initially been set up to run for 6 months, so potentially if you fear you will see an impact and you do in that time, the scheme may still be available to you at that point. When applying for a loan, you will need to approach one of the accredited lenders, there are about 40 of them, and supply information about the company. The Coronavirus Business Interruption Loan Scheme lenders will want evidence that the business can afford to repay the loan. That might include providing forecasts, business plans, management accounts, and so on. The lender will also want an explanation of what the loan is going to be used for. This is so that the lender can check that the loan is suitable for your business purpose and it's the right type of it's the right type of finance for your needs. It's important that the directors consider their statutory duties, as I mentioned earlier in the webinar, when preparing these answers and these forecasts. You might be comfortable that you understand the headline repayment terms that your bank is offering you, but it's important that you consider all of the terms of the loan. And this is a point that is coming home to quite a few of my clients as the detail is coming clear. Each bank is approaching this slightly differently as well, but it's important that you consider all of the terms of the loan, and if in doubt, get in touch with us to review the loan documentation. It may be, for example, that the lender requires the company to refrain from doing something in particular whilst the loan is outstanding. It might be that you're not permitted to repay other loans until the CBIL has been repaid, or the bank might put some restrictions on what dividends can be declared during the term of the CBIL. This may need further consideration by the business, particularly if the business owner's remuneration package has historically included a certain level of dividends. You also need to consider what other facilities you have with the bank. For example, has the company granted an all monies debenture to the lender, and/or have any of the directors or shareholders granted personal guarantees in the past for current and future liabilities? If so, have you discussed this with the lender and agreed that the CBIL facility will be outside that existing security? As Adam mentioned, directors need to consider carefully whether the company can afford to repay the CBIL in the long term, and they should consider and document everything that they have thought about and concluded in contemporaneous board minutes. They also need to consider whether the security the bank is requesting is reasonable and in the best interest of the company and the wider group if there are group companies. It will be particularly pertinent if the security is a cross-company guarantee from one or more companies in the group. Then there may be more complex duties to consider if the directors of the group companies are also directors of the borrowing company. As I said earlier, there are subjective and objective tests for the duty to exercise reasonable care, skill and diligence. If a director is not sure that they have understood all of the issues involved in taking out a CBIL, they should take advice to understand the issues in full, because delegation of the tasks involved, for example, just to your head of finance, does not excuse you from your statutory duties. I'm going to hand over to Adrian now for more insight into CBILS.
Thank you, Harriet. Thank you, Adam. Good morning, everyone. So Coronavirus Business Interruption Loan Scheme, CBILS. It's been around for a few weeks now. Obviously, this is one of the main government initiatives to help support businesses that are struggling through the sort of COVID-19 period. You'll have read much about it in the press, no doubt, and let's be honest, not a huge amount of that has been particularly positive. I am assuming a relatively good level of working knowledge of CBILS on this. There's a lot of information out there, both in the press and on the British Business Bank's website. But I just want to clarify a few areas and note a few other bits and pieces to consider. So I'm going to look at what's going on in the market with CBILS. Some recent changes to CBILS, a few pointers in terms of making an application, life after CBILS, which as both Harriet and Adam have noted is actually going to be quite key, and I think quite an important area to consider, options to go through if you are rejected for a CBILS application. So looking at CBILS in the market first, a lot of focus from the press in terms of low acceptance rates and, money isn't getting out there. Why is that? Well, no great surprise. Big volumes of applications mean that, lenders have got an enormous pile of paperwork to get through, and it's slow. The sort of self-certification point that Harriet mentioned does mean that the British Business Bank is individually signing off each application. That's creating a bottleneck. But actually, the key thing I want to point out on this slide is a bit of good news. So according to the Financial Times, as of Thursday last week, of roughly 53,000 applications that have been made, some 25,000 have now been accepted. So I think we're starting to make headway, and I think it's always been the case that the challenge hasn't been a low acceptance rate. It's just been that applications have been stuck in the pipeline. In the long run, it'll be interesting to see what the ultimate rejection rate is. I don't have any information on that as it stands at the moment. Worth noting, as a final point, that viability, lack of viability, is the main reason for rejection on CBILS. What do we mean by viability? Principally, you need to be able to demonstrate as a business that you were viable before the COVID-19 crisis, and that the stress, the going concern risk almost that you're now facing, liquidity pressure, is due solely to COVID-19. So looking at very briefly, some recent changes to CBILS. Fairly briefly, so personal guarantees are now prohibited for loans of up to £250,000, albeit most of the big banks are already not taking them. It was the case that you had to go through a business as usual product application, and this has been causing, I think, some sort of consternation and confusion. That's also no longer the case, as the borrower can elect to choose CBILS, albeit, again, you must be struggling, as Harriet pointed out, you must need the money. Originally, if you were a sponsor-backed, a private equity-backed business, you were not in a position to apply for CBILS. That has changed, albeit, as we understand it, businesses backed by private equity are struggling to prove viability, particularly, I think, as balance sheets, the way private equity deals are structured, very thin equity, lots of debt, viability doesn't look too clever. At the same time, this was all announced, the CBILS, this is for slightly larger businesses. So CBILS, as you know, is limited to businesses with revenue of up to 45 million. If you're bigger, there's now the CBILS scheme. And as Harriet mentioned, we've now got the Bounceback loan scheme. So a couple of words on making a good application. This is going to be a pretty key lend for businesses. Under undue liquidity pressure, a lot of them are, looking at a fairly bleak outcome. So this is an important, important to get an application right. Really, it's worth noting from our conversations with lenders that sort of professional applications do stand out against sort of fairly rough and ready and amateur applications. The key things that lenders are looking for to understand is pre-crisis viability. What mitigating action has the business taken? So have you furloughed your staff? Have you got time to pay arrangements for VAT, PAYE, corporation tax, etc.? Quantifying the lend, not just putting in an ad hoc application, I'd like some money. Let's actually define what we need, why we need it, what we need it for, and then some form of demonstration, or some narrative at least, around affordability of the debt post-crisis. It must be remembered the debt remains payable by the business and the business only, so we must be able to show we can afford it. Now, as I understand it, from one of the finance associations that supports all the banks, some of the big banks now are not looking for formal forecasts or business plans as a mandatory request. However, our advice would strongly be, given the importance of this application, that this still helps an application stand out. And so if you're able to do that, that certainly adds to it. And the business plan can, add to the narrative, set the context, outline why we need it, what have we done, how are we going to pay it back, etc. And finally, lenders do expect all avenues to have been explored. So what about life after CBILS? This is going to be particularly interesting, challenging if you're an IP, etc. This could get even more busy, I'm afraid. We're going to find a situation where lots of businesses have very stressed balance sheets. Our government support is not clear yet how government support will end. It's unlikely to be a cliff edge, but it will come to an end, at which point you've got a business with its overhead base coming rushing back, an enormous debt stack that needs sorting out, not just CBILS, but of course all the debt you've incurred by not paying HMRC. Maybe you've got repayment holidays on existing debts. All of this we need to now start repaying. And meanwhile, how quickly is your revenue stream coming back? And I think there's a worrying chance that your overhead and your cash outflows accelerate away way ahead of your cash inflows. This is going to be a very dangerous time for challenged businesses. So finally, moving on to what happens if you are rejected for a CBILS application. And I think this is going to become increasingly pertinent now, as I noted, an increasing number of applications have now been processed. So we're starting to see, those that have failed coming through the system. first question, rather obvious, but why? Why have we been rejected? And the bank may give you an outline of that. They may go into detail with it. They may give you some pointers as to what you could do to change your application. Either way, there is value in taking an independent review, and that's something we will be more than happy to help any of your clients with. A quick conversation, happy to help, basically. It could be something as simple as that the application wasn't very strong. In this case, it's probably relatively straightforward, and this is happening. You can simply, resubmit. So let's put that financial forecast in. Let's put together a strong business case, resubmit to the bank, have a conversation with the lender, and actually that may lead to success. We at Quantum have devised some standardized templates for applications which are all sort of available on our website, which can assist with that. There may be some fundamental issues to address in the business where a more comprehensive review perhaps is required. So at Quantum, we've pulled together a bespoke diagnostics tool that, again, I believe is available on our website, and we'd be more than happy to share and help you point your clients into the right direction. Really, that's designed to sort of ask a series of questions to try and ascertain where's the business at, where's the stress, what are your needs, and so on and so forth, and help chart a course forward. Addressing issues, well, that's quite an open-ended point. There'll be as many ways to address issues as there are businesses with challenges. I think key point to note here is our IPs have got decades of experience of helping stressed businesses find solutions and find paths through. So, please do ask. We're very eager to help you where we can. Finally, it may be the case on all options reviews that it's determined there is no banking option. Maybe we've gone back to the existing lender. Maybe we've tried to apply for Siebels from another lender, and some lenders are starting to take on new business now. Maybe we've gone down the ABL route and we've been unsuccessful. So what are you left with if there is no lending option? You could seek private investment from a high net worth, for example, institutional investment, even an accelerated sale, sell what value is left. All of those are likely to have sort of value implications, I suspect, but it may be your only choice. And finally, you're looking at sort of insolvency processes, informal or formal. We are well placed to guide on all of these, well connected to sort of investors and people looking to put money into stressed and distressed businesses, so can help. I think worth saying, all of this sort of sits under the umbrella term options review. All of this is reviewing what are my options, what can I do next. And as a bit of a teaser for our joint presentation next week, we're going to be discussing how to complete our diagnostic and options review in our next presentation. So stay tuned for that. It may be helpful. Thank you.
So thank you, everybody, and particularly Adam, Harriet and Adrian there for their pragmatic insight into a wide range of topics. Can I just remind participants that you can use the Q&A function on this webinar to ask any questions that you might have. So there's quite a lot there to digest. Looking at how to protect yourself as a business owner, how to preserve value where you can through this challenging time, but also understanding, as Adrian was saying there, the changing framework around some of these government-supported funding schemes and the practical application of how to have a successful application go through. I think one thing that was particularly noticeable is the Bounceback loan schemes, which obviously there was a lot of press during the course of yesterday around the sheer volume of applications that had been made, and the way the banks are now trying to approach those to accelerate them. But it is key to note, of course, that is for relatively small loans. Only as Harriet mentioned, only up to £50,000 and capped at 25% of your turnover. So this is for relatively small businesses, but is a very important lifeline for them. I think what's clear there is important to highlight in considering your funding options. the implications and restrictions that you might face as a business owner in taking on these loans, the future obligations placed on the business, particularly around your repayment capacity, not just of the Siebels loan, but also of your existing debt, and particularly if you've taken holidays on VAT and PAYE and corporation tax as well. And then critically, and as Adrian noted, there are around 50% of applications that have not yet been successfully processed. Some of those, of course, will have been rejected, but others are still in the system. So, the key aspects there in that final slide as to, what happens, what your options are if, sadly, you are rejected from a Siebels loan application. I think one of the key things around those rejections is, as Adrian mentioned, the viability test. And that, the first question we've got, Adrian, perhaps to you, is could you set out a little bit more around what we're seeing as to how banks are judging this viability, and if there are test criteria that are important to note when you as a business are making your application?
Yeah, I mean, the key point is, as I said in the presentation, were you viable before the crisis? and in essence, that sort of, the specific criteria will vary slightly between lenders, but it will be what they will apply, the criteria they would have applied to you, let's say in January or February, they'll apply them now, almost retrospectively, trying to put a loan in, I suppose. There's some sort of talk, I think it might be FTSE 250 companies or something, where your net assets must be at least 50% of your share capital. But I think it's going to vary between lenders. We're sort of seeing it's smaller businesses, it's businesses that were slightly more stressed, slightly unhappier balance sheets that are sort of suffering the most. And it's worth noting, I mean, even simple things, in terms of accounting treatment. So if you've got a business where maybe you've written off a lot of your R&D capitalization to the P&L, suddenly you've got, it's taken a big hit to your reserves. Reserves are sort of a smaller portion of share capital, and actually presentationally at least, you may not look viable. I think in instances like that, it's well worth speaking to advisors, because you can look to effectively normalise the numbers that you are presenting to the lender. There's certainly conversations that can be had there to perhaps turn what looks like an unviable balance sheet into a more viable one, and may therefore lead to a successful application.
Thanks for that, Adrian. Adam, I think this one is probably directed at you from a business owner. You've highlighted social distancing practicalities around holding board meetings. And so the question is, I don't think my company's articles of association say anything about holding board meetings by telephone or online. Are there ways in which I can ensure that the company can hold valid board meetings remotely?
Well, the position is his situation is probably okay. Provided the articles don't specifically prohibit holding board meetings online or electronically, then you're probably okay. So in that situation, the articles would allow them to have remote board meetings and to communicate electronically. To be sure, you could actually put something within the articles, which again is just can be done by way of written resolution, depending on the number of shareholders. Amending the articles requires 75% to approve by written resolution. But it sounds like if there's nothing specific in his articles, he should be okay.
Thank you. We've got a question here, Adrian, I think to you, around the private equity point that you were making, asking, have we seen private equity-backed businesses be successful in accessing Siebels loans?
Yes.
And the observation, I think, that this business has a live application and traction is very slow, and there appears to be a resistance to commit. I don't know if you've got any insight there around sort of that private equity side of it.
Yes, some, and the short answer is it's mixed. So I had a long conversation with a managing partner of a PE house last week. they've been putting in a number of Siebels applications over the last few weeks. The answer, unfortunately, seems to hinge on who you bank with. I'm conscious that we've got a number of lenders potentially in the audience, so I'm not going to name names. If you want to phone me afterwards, I'm sure my phone number will be somewhere at the end of the presentation. But you know, so in short, with some lenders, yeah, absolutely, they're willing to sort of take a view on this viability point, you know, and they've got the money. Others are not being so flexible, and they have not got the money. That's a slightly vague answer, I'm afraid, but it is down to which lender you're going through.
Yeah, and I think one of the challenges there is, you know, the obligation to go through your existing lender first. One, because that's the most pragmatic way of doing it. You know, but equally, as you pointed out, for private equity backed businesses, they've often got significant deadlines already as well. And so, you know, I think our experience generally has been that those banks are keen to protect their portfolio assets and are trying to process them where they can. But there is a little bit of feeling through the issues on this viability test. And I know, for instance, that the BVCA is making various representations to try and ease some of those criteria rather than making it a pure mathematical exercise, and trying to turn the viability test into something a little bit more pragmatic. But so thank you for that. Harriet, I think a question for you here around Siebels applications. So the question is, what would be the consequences, for example, of breaching a statutory duty to use reasonable care and skill in preparing information for a Siebels application?
All right, thank you. Well, the duties are owed by the directors to the company itself. So in the event that they've breached those duties, there could be an action against the company by its shareholders, its creditors, third parties. So in the first instance, the liability is owed to the company. I mean, if you've acted honestly and reasonably in putting together your application, then I think the courts are probably likely to excuse you if you can demonstrate how you acted, which goes back to Adam's point about preparing board minutes and having contemporaneous board minutes to show what your thinking was, why you came up with the conclusion that you did, and what you put on the application form. I mean, ultimately, if you in extreme circumstances, fraud and what have you, the ultimate sanction for breach of director's duties is that a court could disqualify you as a director. But if you've acted honestly and reasonably, then that's unlikely to be the case. But in the first instance, the action will be against the company.
Thank you. We've got a sort of a practical type of Siebels question here, probably for Adrian, but everybody feel free to jump in to help. So the question is really around when making a Siebels application, what's the sort of assumptions you should use around when income will flow again? The example given here is of a hotel, and the assumption as to when the shutdown will continue to impact them, not least, I guess, the formal lockdown procedures, but also the practicalities of opening up and perhaps social distancing in there. So have we got any thoughts around how you might approach setting out those assumptions around future income flows?
Yeah, absolutely. There's no one answer. Banks aren't being specific in terms of the assumptions that you make there. Clearly, we don't know when the lockdown is going to end, so that is a bit of a handicap in terms of trying to put that into an application. Our advice to companies making applications or advisors making applications, and what we're doing is I suppose thinking through a logical assumption. That's going to vary from industry to industry, and I'll come back to hotels specifically in a moment. But you might therefore, and this is where I think, even though they're not required, putting in a business plan and putting in a financial forecast does add weight to an application, because then you can show various scenarios. One that we're working on at the moment, we're sort of saying, well, our middle assumption is that life sort of comes back to normal closer to September. But actually, in an upside, maybe everything's back to normal in July, and a downside, maybe it's December. I think hopefully increasingly that downside is looking more and more unlikely. But even then, as I say, it depends on the industry. So maybe an engineering firm or parts of retail could get going quite quickly once lockdown ends. The challenge is then for businesses like hotels or wedding events, even travel companies, is that if your sort of middle assumption, if you like your bank case, you might call it your bank case assumption is September, what that means is that you're coming back to business as normal, roughly, as you go into your quiet season. So and that needs to be reflected as well. So if you're in travel and or leisure, then you need to let's show stuff coming back in September, but then let's bear in mind that the rest of the year is likely to be pretty bad. And that's quite important actually in terms of quantifying how much you need from Siebels. Because if you think if the travel industry comes back in July and it comes back overnight and it's all guns blazing, I know it's highly unlikely, but if it did, then actually you've got your peak season and the main part of the year of your profits is going to come to you. So your requirement for Siebels is that bit lower. Whereas if actually we're not, you're almost having to survive, most likely for travel and leisure businesses, through to next year. So your Siebels quantum is that bit higher, because you've got to survive months and months and months, first of all of COVID-19, and then of your generally loss-making period anyway. So yeah, there is no hard and fast answer, but I think a sensible assumption, well stated and explained to the lender is the best way forward.
Yeah, I'd just add to that really that from my experience, I've got clients in the hotel sector as well, and it is a bit of a crystal ball gazing exercise whilst we still don't have all the information that we would need to have to forecast for a year ahead. So I think it's almost, remember as well, it is a CBIL, but it is any type of other bank funding that you have, and it's keep that dialogue with your bank. If you've got a good relationship with your bank and your relationship manager, keep talking to them. Your first stab at what it's going to look like might change over time, and just keep the bank updated. That's your best way to show your director's duties, to show that you're keeping up to date with everything.
And I think I agree with that. I think, just to add, we are in unprecedented times. I mean, no one's going to know when things are going to change, how businesses are going to be functioning in 2, 3, 4, 5 months' time. So provided you act reasonably diligently, sensibly, etc., and the assumptions you make are properly founded, that should stand you in good stead.
Thanks for that. We've got not so much a question here as the questioner asked, but an observation that customers declined a CBIL loan because of viability. Have successfully applied for a Bounceback loan, despite directors' responsibilities, that they are self-certifying that they're viable. That's actually something that I saw yesterday in talking to a client who had been rejected on that viability point, and had gone back for a Bounceback loan. They're still waiting on their answer. I think the observation I would make around that, and perhaps one of Adam or Harriet could come in a second, around the director's responsibilities about self-certifying, their previous viability, is twofold really. One is obviously the Bounceback loan is a much lower sum typically than these businesses would have normally applied through Siebels. And so, as I was saying to that client yesterday, it's important to establish that the 50,000 loan that you might receive now through this is going to be sufficient to get you through, and therefore forward planning on your cash flow forecasts is even more critical under this basis, because you're judging your own viability. But secondly, I guess this point around directors' responsibilities and self-certification of viability, the challenge here is whether it's a view, I guess, of the director's view of viability, or whether this is a function of your accounting policies historically. For this business in particular, this was a business that has funded itself through loans and invested in intellectual property and software and development areas, and had written that off through the P&L. They may have been able to have capitalised that on the balance sheet in a different way. And so to some degree that would have changed the approach that their balance sheet was presented at the last time. So one of their considerations is in talking to their bank to explore with them whether this is a simple mathematical exercise, or whether there are more aspects to making a judgment on viability through Bounceback loan compared to the Siebels scheme. Adam, Harriet, I don't know if you've got anything more to add around that self-certification point around viability.
Yeah, I mean, again, I think, as we've said through our talk, it's that importance of record keeping and explaining. And as you say, if there are things that the balance sheet perhaps first submitted didn't elaborate on, or there are other things that the directors consider important to the business that perhaps they didn't present to the bank in the first place, maybe there are good reasons for explaining why the directors are comfortable to give that self-certification. It's the contemporaneous board minutes that are important. Explain what your thinking is, and try and explain it as if there's somebody who doesn't know your business at all sitting at your board meeting. Why are you taking this approach? Why are you following on with your plans and taking out loans rather than potentially taking more drastic action to do with the business? It's record keeping is important, I think.
Thank you. I think we've got another question here around, and I guess that this ties in with some of these themes, that an observation that the Bounceback loan is for 50,000, but are you able to borrow a lesser amount, see how that goes, and if then you need to come back and borrow more, you can come back and sort of almost top up that loan as you go through and establish what your needs actually are. A couple of observations on that from me. One of the criteria that you need to state in your Bounceback loan is that you're not either in receipt of a Siebels loan or in the process of applying for a Siebels loan. So you do have to make a choice one way or the other. And so to some degree that precludes you under the current guidance as to whether you could top up your loan beyond the Bounceback loan in the future, although of course that guidance may change depending on how long things progress. But equally, perhaps Adrian, is there any view or insight that we're aware of, and I appreciate it's probably a little bit early to say, as to if you make all these assessments but perhaps conditions apply for a much longer period than you initially anticipated, whether you're able to go back and ask for more money perhaps through Siebels to your existing bank lender?
Okay, so I think the short answer the question is asking specifically, can I borrow 10 and then borrow another 10, for example, all the way up to 50. I don't know specifically in terms of the Bounceback loan, but in terms of Siebels, I understand that is the case, that you can go back and top up if the original lend wasn't sufficient. I can see no reason why it would be any different. So my working assumption would be that yes, you could, but obviously that's worth confirming with the lenders, which we'll seek to do as well. But perhaps a more wider point, which applies to both Siebels and to Bounceback in terms of defining quantum. I mean, bear in mind that there are no fees payable on any of these for the first 12 months. Ordinarily, the advice around borrowing is all about making sure you only borrow what you need. And indeed, I was sort of saying you must be able to afford what you borrow. But actually, because there are no fees to draw down, there's no interest charged on what you draw down, and there's also no fees if you pay back early. There is perhaps an argument to say, well, actually take the maximum that you can. So if you can take 50, even if you think you need 10, maybe take it. Won't cost you anymore, so long as you're able to, and this is the important point, obviously earmark that for either that's the additional pot that I may need in a few months down the line, or actually 3-4 months later when business is coming back, you haven't had to touch it, pay that back for no penalty. So there's another way around it on that. I have read that in terms of Siebels and the Bounceback loan sort of overlap, that if you're partway through Siebels, you can convert that to Bounceback loan, but obviously capped at £50,000. What I don't know yet is if you are successful on a Bounceback loan and maximise that, with it, what you can then do in terms of Siebels. It's fairly apparent you can't have both, but there may be a way to convert between the two. But I suspect that more clarification around that will come in time.
Okay, I think we've just got time for one final question, and it's probably focused around Siebels again. Building on that final point there around rejection from your current debt provider, are you able to, and what are the practical aspects of perhaps applying to one of the other Siebels providers with whom perhaps to date you've not had a prior relationship or a prior lend?
So a couple of points there. Strictly speaking, you can apply, any business can apply to any of the Siebels approved lenders. It is lender policy that is generally driving them to look after their own book first. So, you would speak to they're looking after their incumbent customers first and foremost. So new customers are very much at the back of the line. And that's been the case really since the off. The banks have got huge volumes of this. They've got to focus on their own customers. But that's starting to change a little bit. So first of all, we are starting to see new entrants into the Siebels scheme who are looking to take on non-existing customers. These are generally, we're tending to see these in the alternative lending space. But that means that slowly, and certainly by mid to late June, I think there'll be a number of decent options actually if your existing lender can't take you on. I think also though, and this is sort of pure speculation on my part, so apologies, but if we're starting to see actually that mountain of applications being worked through, which is banks looking after their own customers first and foremost. Once they're at the end of that pile, we may start to see that even the big banks start to look at other lenders' customers if they feel that they could meet their own sort of viability tests. But again, sort of time will tell on that.
Thanks very much, Adrian. So we've reached sort of 10:30, and that's all we've got time for, I'm afraid. Thank you to everyone who's joined us there. And again, thank you very much to Adam, Harriet and Adrian for their insights and observations around those areas of directors' duties and the Siebels loan schemes. Hope you found the webinar useful. Please do join us for our next webinar, which we'll be hosting on how business owners can assess those options for themselves if funding support is unavailable. Particularly looking, as Adrian mentioned there, the diagnostic tools that we at Quantuma use with our clients, and also from IBB, looking at the implications for staff in these scenarios and the key risks around accelerated M&A and processes and that. Details of how to register for that webinar will follow on. If you've got any further questions, then we'll be sure to follow up with you if you want to post those or email them through. So again, lastly, thank you very much to our speakers for taking time out this morning to share their knowledge, expertise and experiences. I hope everyone has a good day and of course stay safe. Thank you very much.